Welcome back to Ben's Book Club. Today we are diving into the book Uncommon Sense. This explainer is all about Michael Kemp's incredible 400-year historical perspective on the stock market. And honestly, Kemp is just a fascinating guy. Get this, he actually spent years working as a periodontist. Yeah, a dentist in private practice. But his sheer passion for the stock market eventually led to a massive career change into finance, and he ended up as the chief investment analyst for Scott Pape's Barefoot Investor newsletter. Having that kind of real-world skin in the game as an everyday private investor before turning pro, it gives this book such a wonderfully self-aware and practical tone. It's kind of part financial history, part skeptical manifesto, and just a totally fresh way to look at how we actually build wealth.
So Kemp's core thesis absolutely flips modern financial advice entirely on its head. I mean, think about it. We are constantly bombarded with complex formulas, flashy algorithms, and those tempting get-rich-quick promises, right? But Kemp argues that smart investing doesn't start with chasing certainty or hot tips. Actually, it starts with deep, unwavering skepticism. True wealth building requires us to look right past the market hype, truly understand the underlying businesses, and just admit that markets are incredibly complex and frankly pretty messy. It's a philosophy that demands patience over panic.
Okay, so let's quickly run through our agenda for today. First, we'll unpack the value of skepticism, then review 4 centuries of market bubbles, debunk some major market myths, look at what actually works, and finally wrap up with the ultimate investor mindset.
Let's jump right into Section 1, the value of skepticism, and why we need to question the consensus.
Now, for any modern investor trying to navigate today's crazy markets, questioning the consensus is absolutely crucial. But here's the catch. Being a contrarian doesn't mean you just blindly run in the opposite direction of the herd. That's not being smart, that's just being stubborn. True uncommon sense means reasonably questioning the actions of the majority and actively avoiding crowd psychology. It's about building your very own reasoned approach. When everyone else is rushing towards some supposedly foolproof trend, the skeptical investor takes a breath, pauses, and asks, wait, does this actually make fundamental sense?
Moving on to Section 2, 4 centuries of bubbles and how history always manages to repeat itself. To really see this crowd psychology in action, we're taking a super fast trip through 4 whole centuries of public share ownership. Kemp walks us all the way from the absolute dawn of the market in 1602 with the Dutch East India Company, right through the wild, frantic speculation of the South Sea Bubble in 1720, into the roaring 20s and the Great Crash of 1929, and straight up to the dot-com bust and the global financial crisis in the 2000s. And you know what's crazy? The company names change, the technology gets better, but the underlying human behaviors, they are completely identical.
That's because, ultimately, every single bubble over the last 400 years shares the exact same psychological fingerprints. Human greed and human fear literally haven't evolved a bit. By looking back at those early share trades in Amsterdam or the massive panic in 1929, we gain this vital, almost superpower-level perspective. Understanding these historical market lessons isn't just some boring academic exercise. It directly improves our decision-making today because it shows us exactly what to avoid when the crowd goes totally mad.
All right, Section 3, debunking market myths, or essentially, what doesn't work.
Time to systematically tear down the sacred cows of modern investing, the stuff everyday people continually fall for. Kemp just completely demolishes the strategies that the financial industry loves, and I mean absolutely loves, to sell us. First up, technical analysis and charting. Look, charts only tell you what happened in the past, not what's going to happen. It's literally like trying to steer a car by only staring in the rearview mirror. Second, market timing. Historical evidence proves time and time again that you just cannot reliably time the market. And third, guru forecasting. Those loud, super confident predictions you see from talking heads on TV, they are fundamentally flawed. Honestly, the people who think they can perfectly predict the market are usually the most dangerous to your portfolio.
And get this, even traditional value metrics aren't perfect. Kemp walks us through things like PE ratios and dividend discount models, but he surfaces a really uncomfortable truth. All rigid valuation formulas require you to predict the future. And guess what? The future is inherently uncertain. There is no magic holy grail metric out there. Extreme overconfidence in math and economic prediction is a massive trap. Don't get me wrong, valuation definitely matters, but it is totally secondary to genuinely understanding business quality and market psychology.
Let's shift to Section 4, what actually works, diving into the roots of value investing.
So, if the gurus are wrong and the math formulas are flawed, what on earth do we actually do? Well, let's look at the trader versus the investor.
On one hand, you have Jesse Livermore, arguably the greatest active trader and speculator who ever lived. Yet he went bankrupt multiple times and, tragically, died broke. On the other hand, you have Warren Buffett, the incredibly patient value investor who deeply understands the intrinsic value of a business and who became one of the richest men in the world. It's the perfect framing for this debate, right? The frantic, stressful life of active trading versus the calm, disciplined approach of true value investing.
This disciplined approach is totally anchored in the tradition of Benjamin Graham, who famously said, "The market is a voting machine in the short term and a weighing machine in the long term." In the short term, stock prices are just bouncing all over the place based on popularity, panic, and hype. It's basically a popularity contest. But over the long haul, the true intrinsic quality of the business is what actually dictates its value. Kemp reminds us that we need to obsess over the business itself, not the exhausting daily fluctuations of its stock price.
But here is where Kemp gets remarkably candid, and I absolutely love this. For all his deep expertise in value investing, he readily admits the absolute powerhouse that is the index fund advantage. Simply leaving your money in a broad index fund and letting it compound over time is an incredibly smart strategy. Why? Because average market returns are actually fantastic returns. Most people are far, far better off in quote-unquote boring index funds than they are trying to pick individual stocks. The real problem here is just ego. People don't like the word average, and we vastly underestimate the extraordinary, grueling analytical work it takes to actually beat the market on a consistent basis.
Finally, let's wrap up with Section 5, the investor mindset, focusing on psychology and philosophy. To actually succeed in the market over the long term, you need immense intellectual humility. Kemp firmly believes that the psychological side of investing is just as important, if not more so, than the analytical math. As he puts it, I haven't met a good investor who wasn't driven by the need to learn and to keep learning. The absolute best investors out there have this insatiable curiosity. They don't just find a magical formula and call it a day. No, they are constantly questioning their own assumptions and always seeking to understand the rapidly changing world around them.
And this constant learning leads to a really fascinating observation from Charles Dow. He said, the more they actually know, the less confident they become. Now, that sounds totally counterintuitive, right? But true market wisdom brings a very healthy lack of overconfidence. When you truly, deeply understand just how complex and unpredictable global markets are, you stop making reckless, arrogant bets. That humility is exactly what provides us with a crucial margin of safety.
So I want to leave you with one final, provocative thought about human nature to ponder today. Are we actually any smarter than those early investors who lost absolutely everything in the South Sea bubble of 1720? Or are we just as vulnerable to the exact same greed, fear, and the madness of crowds? The technology has definitely changed, but our brains haven't. Remember to stay skeptical, stay humble, and always focus on the long game. Thank you so much for joining me for this explainer, and subscribe so you don't miss an episode.